Welcome everyone to the Keystone Midyear Outlook 2026.
Yeah, absolutely. Halfway through the year, over
Halfway
over
through.
halfway through the year at this point.
Absolutely. And I am Jeremy Busch, and with me as always is Josh Nelson. And we figured we'd give you a little change up today where our speakers would be Kevin Bacon and Ethan Hawke,
Yep.
right?
Yeah, and
People might
sorry.
get tired of us.
Yeah, we're just not as pretty. Sorry. Um,
Just kidding.
but unfortunately, you've got us today as usual. Got Jeremy and I. We've actually got four of us now, believe it or not. And we'll talk about the team slide later on. But you've actually got four financial advisors, four wealth advisors with Keystone now. So we've got a lot more capacity to be able to assist you. But Jeremy and I are what we call the senior financial advisors, right?
Correct.
So we are certified financial planners. Our other two advisors are CFP candidates, so working diligently towards that. So we are all highly educated from a standpoint. I think the CFP, my opinion anyway, is that the CFP is the gold standard when it comes to the financial industry. Not everybody thinks that, but I think really that's the one that's probably the most well known at this point.
It is
Yeah.
held to the highest standard,
Yes.
I would say, as far as compliance stuff and education requirements. That's what our compliance says
Yeah,
anyway,
that's true. And
right?
our and it means that you're a fiduciary too. Actually, that's part of the CFP Code of Ethics is that if you are a CFP, you don't have the option of taking that fiduciary hat on and off. You always are a fiduciary. So that is one reason why I think it's the gold standard, simply because a lot of other designations don't have that. They don't have really that. I think what most people are looking for, right, when they're looking for an advisor, whatever words you use, is they're looking for somebody that they can trust. They're looking
Hmm.
for somebody who is a true fiduciary, meaning that they have to, legally, they have to look out for your best interests at all times, whether they want to or not. That's just the way that it is. And I think from a consumer standpoint, sometimes that can be confusing. Sometimes, people think, well, if I'm going to a financial advisor, of course, that means that they're looking out for my best interest. But
Yeah,
the reality is that the requirements, the standards are not the same.
correct. Yeah, absolutely. And then, of course, as always, everything we go over today is our opinions.
Mhm.
So past performance does not guarantee future results. But we have some good data to share with everybody today. And so let's hop in,
Yep.
shall we? We always talk about your financial plan, right? From start to finish or whatever that looks like. And I think a lot of us think of a straight line,
Mhm.
right? Like this is how it's going to be. But in reality, there's a lot of obstacles to overcome
Yeah.
because you're going to have market ups, you're going to have market downs, you're going to have crazy things happening in the world, either politically or economically, that have to tie in. And the purpose of that is just having that long-term plan that's going to weather any storm that really comes through it, right?
Yeah, and then for those of you who are watching the slide presentation, and by the way, for those of you who we're referencing slides, so if you're listening to the podcast, you can also go to our YouTube channel. We'll have this
Hmm.
the video version of this actually, where you'll see the slides and the audio on there as well. But we've got a nice slide there that shows a nice straight line, somebody riding their bike towards the checkered flag, and we all know that's not reality, right? I think it's a metaphor for life, right? That we have our plans and then stuff happens, right?
Correct.
There's always crazy things happening in the world and in our lives and so forth. So it's important to just plan on that and instead of having an expectation that everything is going to be smooth. I was just on an airplane yesterday. It was really turbulent landing in Denver. I expected it to be turbulent landing in Denver because it almost always is. Doesn't
Correct.
make it any more comfortable. I mean, it never does, right? It doesn't matter how many times you fly, still not comfortable.
Absolutely. And we always talk about uh kind of how the market moves, right? No matter what's happening in the world and whatnot. And so we have our little chart of fears, and all across this chart are really just kind of major life events, right? So it goes way back to 1900
Mhm.
here. And obviously, we're going to have things like the crash of 1920, right? That's going to be a big blip on the screen, a big bump, right? But then we see other things, maybe more recent things like Let's see what's on here. So we have the global financial crisis that's on there, or even more recently, COVID or Liberation Day, Strait of Hormuz,
Hmm.
right? And I think the important thing to think here is that when we look at the data and we look at the trend on a long enough time horizon, that the while you're going through these things in real life, they seem like really,
Oh,
really bad,
super scary. I mean, think
right?
about
Super
9/11,
scary.
right? I mean,
Absolutely.
I think for everybody, at least that was alive then, right? We've
Yeah,
got younger clients too, right? Our kids and so forth. They didn't live through that, but for all of us who did, you know exactly where you were that day. You know exactly how you
absolutely.
felt, and certainly there was a lot of personal stuff tied into that as well. But oftentimes the market, when it gets crazy, and it did get crazy, they actually shut down the stock market
Hmm.
uh, for a few days there, I think. It was, crazy. When you look back to what was happening at the time and how much uncertainty, right? We had no idea how bad things were going to get, or there going to be more attacks, all that stuff, right?
Absolutely.
Yeah. So it's not easier. It's not easy being an investor sometimes.
Yeah, and I think that's what this data is kind of showing, right? Is that yes, while you're living through it, it seems really, really terrible. Like, hey, we've never been through this before, or we're gonna, is this gonna really upend the bank or whatnot? But when we look at the chart at the timeline, all of these things virtually are just mostly small bumps along the way, and it just kind of keeps creeping up and to the right,
Mhm.
like the market tends to do.
Yeah, there's never been a bear market or a correction that wasn't followed by an upsurge, right?
Hmm.
There's never been a time, not yet anyway, right? There's never been a market downturn where the market didn't bottom at some point and come back and then actually go higher than it was before.
Yeah, absolutely. So looking ahead for the rest of 2026, really what we're seeing is stocks tend to be the leaders in this. So right now, all the data is basically pointing towards a 15 to 18% gain in stocks. Whereas bonds are kind of a little more limited. They're limited kind of to what they're paying,
Mhm.
right? What their yields are. So in that 3 to 5% range.
Yeah, on the stock side of things too, that's actually an increase from our forecast event earlier this year, right?
Absolutely, it is. Yep. I think earlier we were considering 10 to 12 at the
Hmm.
beginning of the year,
Yeah.
but all of that has been revised up and largely due to the AI boom that's happening. Those companies are spending a lot of money.
Exactly. Yeah, and so the rest of our conversation today basically is unpacking this, right? As far as why, why is it that we expect that not only the market, looking back December 31st, we're predicting based on all the experts and data and everything somewhere between 15 to 18%, kind of the why behind that.
Absolutely. So we'll kind of look at what economy and policy is doing. So we'll start out really hiring is picking up.
Hmm.
So um, largely when we're talking about kind of the health of the economy, employment is always a figure
Hmm.
in that, right? And so when we look at the past 5 quarters annualized, real GDP is about 1.9%.
Hmm.
So we're a little bit down from where we were, but largely with hiring, again, AI is helping with this a lot.
Hmm.
That's spread out across quite a few companies actually
Yeah, it's
with
actually
that.
kind of a surprise. The prediction a few years ago, right, when remember ChatGPT and everything, and all these doom and gloom predictions of, oh my gosh, AI is going to replace all the jobs, and maybe they still will. Someday we still have jobs, right? I feel
Right.
good about that. But the reality is that there are actually more jobs now, and we're not seeing mass layoffs.
Absolutely. Yep. And so it's nice and widespread, I think, for the most part. But then again, the other big part of this is again, big tech is hitting the gas. So when we're looking at the major players in this, your Microsoft, your Alphabet, Amazon, Meta, Oracle, these numbers were revised up as well. So kind of what they were expected to be spending on this for 26 and 27 from the beginning of the year is actually quite a bit higher
Yeah.
for the remainder of the year. Again, 26 and 27, they're really kind of jumping on this. And I think really what we're seeing is what I hear a lot of anyway is, hey, there's fears of a bubble in AI,
Hmm.
right? And so typically, what we see here is, the fact is that actually the money that they're spending on AI, all of these companies, the money they're spending is not necessarily debt driven. It's really coming from profits and earnings that
Yeah.
these companies have already earned. So they're not necessarily leveraging anything or going into debt in order to finance all of this. It is pretty strictly coming from profits and earnings.
Yep. And by and large, yeah, earnings are driving it. That's a big difference from the late 90s. Those of you who remember that, right, and the tech bubble and so forth, that, back then, a lot of companies actually were not profitable and never were profitable, right? And they disappeared.
Yep.
So, but yeah, I think that's the key right now is earnings, earnings, earnings. AI, AI, AI. You're going to hear that theme a lot throughout our presentation today.
Yeah, absolutely. And then, of course, when we were looking at S&P estimates, so really these have also been bumped up, but we see basically three main sectors that are really
Hmm.
pushing it at this point, right? So we have technology, energy, and materials. And again, a lot of that comes with AI push, building
Hmm.
data center,
Yep.
et cetera, with a lot of this.
Yeah, absolutely. And I think, kind of back to one of the charts we don't have on here, one of the ones we like to show sometimes is what's called the Callan chart, which actually lists all these different areas, right, year by year through history. So what this doesn't mean is we don't think you should time things. In other words, we don't think you should,
Definitely
oh,
not.
let's just pick those three sectors and leave, all the other stuff out, industrials and consumer spending and so forth. So a good diversified portfolio is going to be spread across all sectors, but that doesn't mean you just set it and forget it, right? So the responsible way of investing means that you're going to be actively taking a look at opportunities, right? Doing responsible rebalancing, and so that's certainly what we do when we're looking at client portfolios.
Yeah, absolutely. Yep. If anything, stay diversified,
Hmm.
right? But of course, when we talk about AI, we have to come to reality, right? Is it's not all rainbows and butterflies,
Hmm.
right? So a lot of what's coming with this, what we see is that AI is also directly impacting kind of inflation numbers.
Hmm.
And so a big reason for this is the supply and demand, right? And
Hmm.
so when we're talking about that materials sector, right now, a lot of these companies are trying to do what's called AI build outs for a lot of this stuff. But the materials are not necessarily in high supply.
Hmm.
The demand is there. And those two factors, economics 101, when you combine them, is really just kind of driving that inflationary factor involved with that.
Yeah.
Kind of going back to that AI bubble. So this is different from the 90s
Hmm.
when there was kind of a bubble, and what we saw basically was prices were collapsing because there was an overcapacity and an oversupply.
Hmm.
And so we're not here at that point right now. Now, could that eventually change if, materials get blasted up? Absolutely, it could. Something to always keep an eye on. But currently, the data does not support that idea.
Yeah, absolutely. And when it comes to some inflation is not terrible, right? You actually don't want deflation. That would be the economy actually going backwards, right? And
Hmm.
a disincentive for people to spend money. So some inflation is actually good. Right now, our inflation is actually higher than what the Fed would prefer. So that's something that's going to have to be contended with. But certainly, and one factor with inflation definitely is AI. So it's a positive and somewhat negative as well.
Absolutely. And really, the other thing the data is telling us about inflations is it's really broadened out. So it's not necessarily a few specific
It's not
things
just eggs
anymore,
or toilet
right?
paper,
Exactly.
like
And
during COVID.
so
Yeah.
a lot of things kind of impacting this. Obviously, the Strait of Hormuz has had an impact on this, mainly for transportation and fertilizer costs. When you put just those two things alone,
Hmm.
every cost of your good trying to get it to the store from
Everything.
where it
It's like a
is,
tax
or
on everything.
growing
Yeah.
food or anything like that. Obviously, that is impacting everything. And so, really, I guess the idea here is that this probably isn't going away anytime soon.
No, and it's a yo-yo effect. It seems like every day, right? We're hearing, things are flaring up, and the Strait of Hormuz is closed, and oil is, spiking again. And the next day, another headline. Oh no, they're going to be talking again, right? And oil prices have plummeted. So I would agree. I think it's going to be a broken record. We're going to
Yep,
be contending with this for a while.
absolutely. But kind of like we had mentioned at the beginning of this, is that hiring is picking back
Hmm.
up, right? And so unemployment is still very low than now, so 4.3%.
Hmm.
Kind of a key number in here is what they call prime age employment. So anybody aged 25 to 54. That's kind of your biggest working sector,
I'm getting there.
right on the
I'm getting
edge,
there. I'm still in
right?
that range. I'm still in my prime.
Right. But that hey, that demographic is actually holding pretty steady at about 80.8%, which oddly enough, during the expansions of the 2000s and the 2010s, that number is higher than what it was back then.
Yeah, yeah. One interesting fact is that you will look up until the late 90s, early 2000s. The economists, I mean, the experts, right? Up until that point, full employment, which means that pretty much everybody who wanted a job had a job, maybe not the one you want, right? But it's a job. Up until then, 5% was kind of the target. That if you were under 5% economically, that meant you were a full employment. Yeah, we've been under that pretty steadily, except for COVID,
Hmm.
right? There was a spike during that time for sure. But yeah, unemployment has stayed really low, and that's super important. We're going to talk about consumers later, but consumer spending is what drives the economy. 70% of the economy is just us spending money on
Absolutely.
stuff, and
Yep.
people are right. I mean, you go to the airport, you go to a concert, go to a show, anything, right? People are out there doing stuff. They're spending money.
Absolutely. And yeah, and really the consumer is hanging in there. Really when we look at the data here, so we always look at two kind of factors or the powers that be. Let's say look at two factors. So nominal GDP and real GDP. Now, the difference for anybody who doesn't know, and gonna admit we looked this up
Hmm.
so we could put this into
We
good
did.
terms for you, right? But real GDP is always usually a lower number. But real GDP, what it does is it looks at what the price of something was a year ago, and then inflation adjusts that price, usually down,
Hmm.
depending on where inflation is, to kind of say, hey, this is what it would have been compared to a year ago, right? Nominal just looks literally at what today's price is.
Hmm.
And the important thing to think about this when we're talking and emphasizing nominal prices is because nominal is ultimately where what's driving the market right now,
Hmm.
right? Because that is that's the price companies are getting right now for their goods. And so that affects things like margin and profits and things of that nature.
Hmm.
And so nominal spending is up by quite a bit, no small margin.
Yep. Again, people are spending money. So consumers, that's something we pay a lot of attention to is do people have jobs? If they have jobs, they have money, and are they spending it?
Absolutely. And kind of go along with that. So activity is still very strong. So again, like you said, 70% of the US economy is people just spending money, and we really don't see that going anywhere. The data doesn't really suggest any recession factors
No,
built
odds are
into
pretty
this right
low.
now as well.
Yeah, odds are pretty low, knock on wood. Obviously, there's always shock events, things like that that could happen. Example 9/11, right? People all of a
Hmm.
sudden got really scared and stopped spending money for a while. Same thing with the pandemic, same thing with, yeah, the global financial crisis, right? I mean, that's probably the biggest one in any of
Yeah,
our lifetimes, right? That everybody got scared at one time and stopped spending money.
yeah, absolutely. Another thing we hear a lot about is kind of comparing today's inflation with maybe the hyperinflation of the 1970s,
Mhm. Yeah.
right? And obviously, yes, there's reasons that that's out there because there are some correlations to be
Hmm.
had, right? And so when we look at this, originally we were expecting at the beginning of the year about 1 to 2 cuts from the Fed
Hmm.
on interest rates. At
Yeah.
this point, that's
Not
pretty
going to
much
happen.
off the table, and they're kind of actually talking about maybe a small bump.
Yeah, some surprise actually last week that they didn't raise rates.
Hmm.
That still could be coming. I think actually fairly likely unless we get some good surprises with inflation dropping.
Yeah, yeah, absolutely. So that is definitely something to keep an eye on, of course. Of course, the biggest factor with that too is that, a small bump up, we could probably handle that, right?
Hmm.
The market could probably handle
Hmm.
that as it goes along. What really screws things up is when the Fed just slams on the brakes,
Yeah.
right? Like they did in COVID and things of that nature.
You look at COVID. I mean, obviously, lots of bizarre things, right, happened during that time, right, as far as supply chains and so
Hmm.
forth. But yeah, there's a massive slowdown, right? Everybody stopped spending money, and then trillions of dollars of money from the government came kind of plowing back into the system. 10-cent people and jobs came back. Then, of course, then you have a supply problem, right?
Yeah.
All of a sudden, then you've got supply chain problems, right? Because that all got interrupted and shut down. You don't just start that back up. So lots of crazy stuff happened 2020, 2021, caused an inflation problem. And obviously you could debate this, right? Different economists have different opinions, but the Fed probably waited too long to start tightening up. And so we had a big spike in inflation, slammed on the brakes 2022. Some of you might remember your portfolio probably went down about 20% that year. Didn't feel good. Right? Things came back,
Right.
but we're hoping that we're not repeating that scenario too. So that's one of the risks if the Fed is too loose, right? And then inflation actually keeps taking off, then eventually it ends up being this, kind of knee jerk thing, right? Where you start stopping really uncomfortable ride.
Yeah, absolutely. But on the bright side, really what the data also tells us is that stocks are kind of the place to be, right?
Yeah.
Because if there's one thing that's out there that really does handle inflation well, it is typically stocks and equities.
Yeah, stocks and real estate are really the two in our time, right? Maybe there'll be something else, Bitcoin, maybe that becomes, something in the
Right.
future. But as far as something that has been pretty predictable, right? Following patterns over the last couple hundred years, being an owner, right? Participating in capitalism, you've got stocks, you've got real estate, you actually own something that can outpace inflation from a return standpoint. You can't get that anyplace else really consistently anyway. Fixed income, even gold, commodities, things like that, sometimes can match inflation. Sometimes they can be a good diversifier, but stocks and real estate typically are going to be your best inflation hedges.
Absolutely. And again, that kind of carries as long as the Fed doesn't, I guess, wait too long
Right.
and then
Yeah.
have to slam on the brakes
Yep.
and
Yeah.
jump rates up quite a bit
Yeah.
really fast. Yeah. But right now, what we're seeing is that the momentum is really running pretty hot,
Hmm.
right? So again, stocks sit near top of historical range. In fact, as of the time of this recording, yesterday the Dow and the S&P just hit new highs
Yep. Sure did.
as well. And so I was thinking maybe we need to do these a little more often because it seems like every time we do one of these,
Yeah, I know.
market takes a
We
bump
could.
up. I don't know. But so again, overall equities. Um, Again, kind of going to that AI factor, right? Because
Hmm.
that seems to be the thing that's really driving a lot of this stuff.
Hmm.
Um, so a lot of these companies, your Google, your Amazon, Nvidia, Microsoft, they have kind of two major factors involved with their earnings,
Hmm.
right? And so they have the business that they're doing, and then they have private investments.
Hmm.
So
Yep.
private companies that they're purchasing that get revalued from time to time.
Yeah.
Now, when we look at this, this is actually a fairly good sign. So, some of these companies, Alphabet, Amazon, half, maybe a little bit more of their overall net income in, even if we're just looking at quarter one, came from private companies,
Hmm.
right? And so, and not necessarily that that's a bad thing. Those private companies are doing well, and so they're getting
Yeah.
revalued up,
Yeah.
right?
Absolutely.
But then the other half of that is strictly coming from profits,
Yeah.
right? So at nominal price, they're getting good margins, they're making a profit on their stuff. Whereas companies like Nvidia and Microsoft, their private amount is only about, in the 20, 25, 27%
Hmm.
range. Whereas everything else that they're spending, and when we're talking about this, we're talking anywhere from 35 to 60 plus $billion just in quarter one.
Yeah.
Those two companies, they're, massive, massive profits
Yeah.
that are happening. And that's just
Yeah.
Q1 data.
Yeah, absolutely. And we'll see what happens as we go into this fall too, because the market conditions appear to be good right now. You might find more of these private companies end up going public. Probably one that's been in the headlines more than anything has been SpaceX. We were getting lots of questions about that. The stock price
Hmm.
hasn't done great so far, right? But many of these big companies like Google actually owned a pretty good chunk of SpaceX stock, right? So it was privately held before. They've been holding it on the books for years and years, and just more recently that went public. So whether you like it or not, it could be maybe you want SpaceX or one of those companies, maybe you don't. But the reality is, when you own these big companies, poster child probably is Berkshire Hathaway, right? It's almost
Yeah,
like a mutual fund, right? Buying it, you actually own pieces of all kinds of different businesses and companies. So oftentimes that is what you're getting exposure to when you own big companies like this.
absolutely. And really, again, kind of going back to the beginning of the year to now, the earnings, when we just kind of looking at the S&P overall, do point higher,
Mhm.
largely because it is earnings and profits that are feeding all of this, which is really what you want,
Yep.
right? It's
Yeah.
not necessarily speculation on, I think this company is going to do really
Yeah.
well,
Definitely don't want that.
right? Which
Yeah.
can temporarily bump things up, but it's that earnings thing that's really what drives the market and keeps pushing it higher
Yeah,
over time.
earnings are the only thing that's really real, right? Earnings and cash, as
Hmm.
far as what a company is actually worth over time. So extremely important, and not only current earnings but projected earnings, and that's what we're seeing, is very very strong and accelerating forward earnings.
Absolutely. And when we talk about earnings, a lot of that is the margins. And so, of course, the margin is literally just the amount of profit,
Hmm.
right, that
Yep.
they're getting off of their product, whatever they're selling. And the margins are climbing as well
Yeah,
for
they're
this.
controlling costs, and certainly, sometimes, if revenue is accelerating, they might not have to spend more money to get to that point. Again, they can choose to go ahead and deploy that money, like in capital expenditures. That's a choice, right? If you have earnings,
Mhm.
you've got cash, you can take that and do different things with it. You can pay down debt, you can do capital expenditures. So that's different, right? The earnings are there.
Absolutely. Yeah, but as always, volatility comes with the territory.
Mhm.
It's the toll we pay to invest,
Yep,
right?
back to our slide at the beginning, right? Kind of the craziness of life, craziness of the economy, the world that's not going anywhere.
Absolutely.
Yeah.
So, with that, just a couple key items to
Hmm.
remember. So, a 10% correction. Technically, we didn't actually hit a 10% correction
Hmm.
in the first quarter of the year. It was like 9.7 or something
Hmm.
right around there. So, pretty
Hmm.
close. But those happen about once a year.
Yeah.
Something like a bear market once every about 3.5 years. But smaller things like that. So, 1% dip, we get about seven of those per year,
Hmm.
right? And so that's just a crazy day in the market, right? We
Yeah.
see plenty of those.
Yeah, yeah, it's statistically it's just part of the game. If you're going to get on an airplane, you're going to get turbulence. What's predictable that hasn't happened yet, and I think is an important thing to ask yourself, is that if you're a stock investor, if you're on an airplane, what's predictable that hasn't happened yet? Well, it's predictable that you're going to get turbulence going into Denver.
Yep.
All right, so just expect it. Enjoy it, probably not, right? But just expect that it's going to be there, right? I think that's where upset comes is when things don't match our expectations, right? So I think it's important to just recognize that part of the game here, part of being an investor, is actually staying in long enough. Really, time is such a huge factor, and the noise of politics and craziness and wars and all that. Not to say that they don't matter, right?
Hmm.
Not and personally, I get it, they matter, but from an investment standpoint, if you've got time, really, these things, back to our chart of fears again, those things tend to even themselves out over time. And most of the time, we don't even remember them. If you go back
Yeah.
to some of the year, we could list off a bunch of stuff that happened that at the time seemed pretty significant, like the Greek debt crisis, right? I mean, I think that was
Yeah.
back in 2011, something like that. The European debt crisis, and it caused a lot of volatility in the markets. And oh my gosh, all these uh, Southern European countries, which were very debt laden and still are, actually, they're going to actually sink all of Europe because all the European banks that they hold all their debt, and it's going to, cause this massive financial crisis. That didn't materialize, right? I mean, most of you, as I'm describing this, you're like, "What?" Like, don't even remember that it happened. But
Right.
at the time, it was pretty significant.
Yeah, absolutely. Yeah, absolutely. But the Bulls are still missing. And so this
Yeah.
is kind of one of our favorite data sets, I
Hmm.
think, the American Association of Individual Investors,
Yeah.
right?
I hope none of you
Uh,
are members of the AAII. If you are, I'd like to talk to you because if you, because I'm going to do the opposite of whatever you think. Right now, I'm going to do the opposite. Statistically,
absolutely.
they are not very successful with their picks.
Yeah, so I'm not going to make anybody do the math on this, but we're looking at about 40 years worth of data, and I counted it up, and 33 of those 40 years, which works out to about 82% of the time,
Mhm.
the AAII is way off
Yeah,
with what they're expecting versus what actually happens in the market.
yeah.
And so yeah, it's one of those things where if you just do the opposite of it, you're more than likely going to come out on top.
Yeah, I mean, I don't mean to pick on anybody, but the AAII largely is people who are kind of self-directing their own investments.
Hmm.
And some of you probably do that on your own, and you do a great job at it. Maybe you're very disciplined, right? But statistically, not. The average investor left to their own devices does the exact opposite of what they should, right? They because it feels good to buy when things are really high, even though it's like, what? That doesn't make any sense. But when the market is just going up, 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 a lot of the gains have already happened by the time that these kind of people get bullish,
Mhm.
right? So it ends up being really crazy, right? Because you end up buying high and selling low when things feel bad, and you really don't
Yep.
want to do that. You want to buy low and sell high. That's the first rule of investing.
Absolutely. And to kind of go with this, so um, really what this is saying, current year, bulls are near zero
Hmm.
right now. At the midpoint of this year, S&P 500 was up about 10.8%.
Hmm.
And the nice thing was is that wasn't just, the Magnificent Seven or anything like that. If we look at the S&P 500, over 490 of the companies in the S&P 500 had double-digit gains
Yeah.
for the year.
Yeah. So we're no longer talking about a handful of companies.
Yep.
Yeah.
We're pretty widespread. And of course, being a midterm election year, we'd be remiss to not at least talk about it. And so, really, what we see is a mid-year election year. Usually, the average down point, I guess, in the
Hmm.
market during the year is about 17.5. But really, what we see is the very next year, the market gain that we see a
Hmm.
year from when that happens is up about 31.7%.
Yeah.
And that's no small margin right there either.
No, not at all.
So, despite the fact that markets have kind of been at a high or hit a new high, even
Hmm.
within the last day or so, the one thing the data is showing us is that value is still out there,
Yeah.
right? So, broadly overall, all of these, especially when we're comparing 2025 to 2026, and a lot of that's coming from earnings,
Right.
right? So, because these companies are making good earnings, there is additional value to be had in those.
Yeah. Yeah, exactly. And it's all about earnings. I know we've been talking about that over and over, value, earnings, AI, but really, especially because earnings have been so attractive relative to where we thought they would be. There's a pretty good case that even your big tech companies, some of those are a better value than they would have been 6 months ago, a year. But really, we want to diversify beyond that, right? Not just large cap US stocks, but international, small cap, mid cap. We want to make sure we've got exposure to all these areas.
Yeah, absolutely important to have a little bit of everything,
Hmm.
right? Now, the other nice thing about this too is that um, people keep asking us, what about this bull market? How long does it have to go,
Hmm.
et cetera? But the data really shows that the average bull market returns about 260%
Yeah, isn't that
over its
crazy?
lifetime.
Yeah, yeah,
Absolutely.
it's true though.
Yeah.
Yeah.
And so currently as of this one, we're at about 101%
Hmm.
roughly. So that right there basically tells us that there's room to grow. But then the timing of it, your average bull market is about 5.5 years
Hmm.
in age. Obviously, we can go back in time to some of our bigger events, right? Where there was like a 12-year bull market or an 11-year bull market after uh, 9/11,
Yeah,
right? For a
yeah,
lot of that. And so we're still fairly young with this one, believe it or
yeah.
not.
Not that you would ever want to time the market. Really, I think if anything, the moral of the story is the people that are able to hang in the longest, right, are the ones that make the most money in the market, not people who get the timing right.
Absolutely. And the market tends to reward the patient.
Yep, yep,
That is age old.
for sure.
And so when we're talking about bonds, of course, bonds are always going to be a part of there. Like we had mentioned near the beginning of this broadcast, is that really it's the yields of the bonds that are going to be doing a lot of payment. Not a lot of move probably in returns per se, but the interest that they're paying.
Yeah, I really think about why bonds are in your portfolio to begin with. They're like the least exciting investment, cash and bonds. And then they're not very good inflation hedges, right? They tend to just
Correct.
produce income. They produce stability most of the time, right? Sometimes, like in the year 2022, when the Fed had to stomp on the brakes, that year we did see bonds go down in value quite a bit, price wise. But this year, we think just yield only, as long as the Fed doesn't have to get too crazy as far as increasing interest rates. We think that you're just going to get the yield in that 3 to 5% range.
And keep diversified even amongst your bonds,
Absolutely.
right?
Yeah.
Not put all our eggs in one basket.
There's a lot of different risks, right? And you need to understand the risks not just in stocks, but also in bonds.
Yep. And then, of course, being a midterm election year, we
Hmm.
got to talk about
Of
that.
course.
But the general idea is that, like we could throw a bunch of different charts at you that basically say all the same thing, but overall, the market really doesn't care who's sitting in that chair.
Yeah. Yeah. If you think about the market, right? It's consumers, it's not spending money, it's CEOs of big companies making business decisions. Obviously, it matters to them from the standpoint they need to know that the environment that they're operating within is going to operate a certain way. Policy does matter. So it's not to throw it completely out the window, but for a long-term investor, who's in office doesn't really matter all that much. You can look at plenty of examples, both blue and red, or somewhere in between, as
Hmm.
far as government operating just fine from a market perspective.
Yep, market does not pick
Mhm.
sides. And oftentimes, what we see, and the data supports this as well, is that markets like gridlock when
Yep.
it comes to the political system.
Yep. And then more likely than not, who knows, right? We've got a few months until the elections coming up here in the midterms. More likely than not, I think prognosticators are saying that we're going to end up in some type of a gridlock situation.
Hmm.
So as an investor, at least you should cheer that on, right? Maybe you don't like that personally, whether you're left or right, either way.
Yep.
But as an investor, you should cheer that on.
Uh-huh. And really what we see is over years where we're looking at this. So this goes back quite a few years, but your general returns are somewhere around 17% when
On
we have a
average.
gridlocked political system.
With a split Congress. Yep.
Yep.
And again, more than likely, that's what we're going to end up again is somewhere close. We've been operating in a very polarized environment where things kind of swing back and forth, left and right. But yeah, more than likely, that's where we're going to end up after November. And again, either way, regardless of what the outcomes are, if you're a business leader, if you're a consumer, everybody, and you can bitch and moan about it and not like it, right? But everybody's still going to move on, right?
Yep.
And figure out the new environment that they're operating within. So either way, even if the outcome isn't what you wanted it to be, that doesn't necessarily mean it's a bad thing from an investment standpoint.
Absolutely. The market just does not pick sides when it really comes down to it.
Mhm.
Well, thank you from all of our team here at Keystone. We're up to 12 individuals now, all here ready to serve you and take care of your needs and whatnot. Couple new advisors coming on, like Josh had mentioned.
Mhm.
We got Jen and Michael who are sitting for their CFPs here this fall.
Yep.
But we just kind of continue to expand, largely thanks to our clients and being able to serve your needs.
Yeah, it's certainly been fun along the way. Keystone started in 2010, and many of you, again, I've worked with before, a number of years before that. But it's been fun to be able to build out a team. Certainly not just do this alone. And I think we're able to be a better fiduciary for you because of it, because you're
Yeah,
not just
absolutely.
relying on one person, right, or one set of ideas. You've got a whole team that's really operating to look out for your best interest. We are a fiduciary, and that's not the same at all firms. So it's important to think about like really who it is that you want to be able to trust, who can you rely on, especially when things are tough, whether that be
Mhm.
in your life or from a market perspective as well.
Yep. So, any questions or concerns, if you want us to look at your personal situation, anything like that, you can always find us at keystonefinancial.com. You can email Josh at keystonefinancial.com. You can email Jeremy at keystonefinancial.com, or you can always just use the phone number, right?
Right.
970-744-5408. We are here ready to take your questions.
Yep, absolutely. Any questions you've got, any follow-ups, not only from existing clients, but also if you're considering Keystone or if you've got a friend that's considering Keystone, it's an easy way to introduce somebody just by email, or just let us know. If they're wanting us to reach out to them, we can certainly do that. Sometimes there's opportunities too, like passing on the podcast, passing on webinars, other things like that. The podcast, it's actually, we found that that's a good way for people to kind of get to know us a little
Yeah.
bit if they're not quite ready to come in for a financial consultation. So thank you so much. Appreciate your support, appreciate your friendship, and we hope you have a wonderful week.
Take care.